This is the Asia Trade. I'm Paul Allen in Sydney.
I'm Avril in Singapore. Your top stories this hour. A mixed open ahead for Asia with cooler US inflation supporting an extended Fed rate pause, election speculation boosting Japanese stocks and pushing the yen deeper into intervention territory. JPMorgan leading a slide in Wall Street banks as fee revenue unexpectedly falls, missing even its own guidance. And President Trump tells Iran's leaders to show humanity, promising protesters that help is coming as activists say thousands have already been killed. Now, in terms of stocks in Asia, don't forget we already had the region's benchmark at a record just a day ago, led by Japan. We're hearing from local media, the likes of Nikkei, that the Prime Minister could today announce that intend to dissolve the lower house of Parliament. So growing bets towards an early election, and that seems to be fueling further this Takaichi trade. Don't forget, we already saw the Japanese gauges at records, the yen, the weakest against the greenback since July last year, underperforming versus G10s, JGBs. There was an onslaught. We have a 5-year auction later today to get through as well. Now, on top of that, we have jobs data out of South Korea. The jobless rate unexpectedly higher than the consensus that was 2.7%. So we're seeing a much higher jobless rate than economists had predicted. Keep in mind, we also have a BOK decision that's due tomorrow, not expected to change on rates. Also keep in mind how the Korean won has certainly been on this weakening trajectory for much of this year. In terms of the early goings in the Australia stocks, we're watching BlueScope as well. It did announce a special dividend not long after it sort of fended off a takeover bid from SGH. Paul.
Yeah, let's take a look at how things happened in the US. It was a weird day. We had markets initially higher on that CPI data, but then things began to fade after JPMorgan announced investment banking fees missed expectations. That stock off 4.2%. So that wiped out a lot of the gains that we saw earlier on. We'll get into that a little bit more in a moment. But as to that CPI read, that was kind of interesting as well. Definitely evidence that inflation is moderating. Core CPI in particular rose less than expected. This is the number that strips out those volatile food and energy prices. But the deeper you dig into the data, the more curious the picture becomes. We'll discuss that a little bit more as well. Not a lot of move for the 10-year, 4.1792. It's been range-bound most of the week, but the 2- and 5-year notes both fell about 3 basis points after that CPI data. 30-year bond auction also saw pretty strong demand, April.
Let's talk a bit more about this inflation data. For more, let's bring in our U.S. economy editor, Molly Smith. So, Molly, talk to us about the components, what went up, what went down.
Right. So this was a tricky inflation report to prepare for because you have to remember we came from a report in the previous month that was really complicated by the government shutdown. There weren't prices for October. They had to compute a 2-month change. So there were some categories that were artificially low in November that we expected to see bounce back in December. And that did happen for a few categories, even though inflation as a whole was less than expected. So the ones that we saw bounce back were shelter. That was a big one, as well as recreation. Those and airfares and hotel stays as well were the big ones. But there were also price declines in some other categories. So it really did end up leveling out. And where you saw that inflation came in less than expected, that's where we're now thinking that maybe this is a more confident sign that inflation is on a downward trajectory since the last report was so complicated.
Yeah, within those numbers, though, there were a few odd things as well. We saw an outsized drop in wireless phone services, a few other curious numbers also. So what signal should we take from this, particularly when it comes to the path ahead for the Fed?
Right. So, a lot of economists were saying that this is all in all, on the good side, at least, we can say that this continues to show that the tariff impact so far to consumer prices has been mild, or some economists even said maybe it's peaked. Granted, though, when we're looking at what this means for the Fed, there's still really no expectations that the Fed's going to cut rates this month. So if anything, though, there's really more that's building that it will happen in the first half of this year. So it looks like that first hike is fully priced in now by the June meeting.
Yeah, we'll wait to see when the Fed cuts next. But talk to us as well about this pressure that the central bank is under from the Trump administration and these growing calls, the solidarity, the support for the Fed chair.
So it's one thing that Trump has been for months, maybe longer, going after Powell to cut interest rates and, calling him names that he's too late, kind of like nitpicking at these little things. And Powell so far has been very professional about it and really has not responded to a lot of these, comments from Trump. But this was a dramatic escalation by stepping up with a probe from the Justice Department, perhaps leading to a criminal indictment. So this is very, very serious. And Powell was steadfast in defending himself and defending the institution. And that's what we've seen as well from central bankers around the world who joined a statement. This is from ECB joined this statement, as well as the Bank of England, Bank of Korea, really a global effort to stand behind Powell in solidarity, as well as JPMorgan CEO Jamie Dimon. He also said on the bank's earnings call that, Fed independence is so crucial and that without that, you could see borrowing costs rise, and this is a wrong move to go after the Fed like this.
All right, Bloomberg US economy editor Molly Smith there. Well, JPMorgan has kicked off the latest earnings season for Wall Street's big banks on something of a down note. Shares tumbled the most in a month after an unexpected drop in investment banking fees, missing its own guidance from just last month. Let's bring in Bloomberg Intelligence senior industry analyst Matt Ingram for more. So, Matt, investment banking fees were weak. Trading revenue, though, beat the top end of the range. So does this bode badly overall?
Yeah, g'day, Paul. Look, I guess it's useful to put it in context. JPMorgan's one of the most expensive banks in the world. So like we saw here in Australia with CBA, a little miss means a big miss for the stock. Obviously, diversification is important at JPMorgan, and what we saw was really strong prime brokerage, which had that 40% uplift in equities revenues. So is it bad news? No, definitely not. JPMorgan said a lot of the issues with investment banking were timing related. The pipeline remains strong. Looking ahead to later in the week, that strong prime brokerage is really good news for Morgan Stanley and Goldman Sachs.
Okay, what about this threat of a credit card rate cap from the Trump administration? How big of a headwind would that then be for these big banks?
Yeah, well, it's a big question, Avril. There's a lot of balance sheet across the big US banks committed to credit cards. For JPMorgan, auto lending and credit cards was about 15% of revenue in the December quarter. So it's a really big deal for JPMorgan. Also a massive deal for Citigroup, less so for Wells Fargo and Bank of America. But clearly there's a disconnect between reality and the economics of this, but it's something the banks are going to push back on for sure.
Yeah, talk to us about the impact of that potentially on JPMorgan, Bank of America and others. How would that weigh on their card business?
Look, it's a very important part of their customers' business. A lot of businesses require it for cash flow management and so on. In terms of the economics of it for the banks, it would become unprofitable, Paul. They need this big juicy yield in order to make the lending economically viable. They have very big credit losses on those businesses. They're extremely expensive to run. And a 10% yield on that kind of loan, the banks would be forced to walk away from that kind of business. So it's not great news for US consumers, and it's not great news for US business if banks have to walk away.
Yeah, what else are we hearing about the US economy from the likes of Jamie Dimon based on what the banks are telling us?
Yeah, look, the US banks, Avril, are quite upbeat about the economy, and I guess that was echoed in our conversations before regarding the CPI reading. It's really good news for these big US banks if that's the case. If the Fed doesn't have to cut more, and if indeed the rate hike is the next move from the Fed, that's extremely good news for the big US banks. I know Dimon talked about funding costs, but gee, they're pretty leveraged on their deposit side to healthy interest rates, and so that would be very good news, I think, for those large US banks.
Matt, thanks very much. Our Bloomberg Intelligence Senior Industry Analyst, Matt Ingram. For more, let's bring our executive editor for Asia Markets, Paul Dobson. So, Paul, despite the cooler than expected core CPI numbers in the US, you saw the stock run up, kind of running into a wall. What do you make of the moves overnight? What does this mean for Asia?
Yeah, well, I wasn't expecting a great reaction one way or the other from the inflation data, and in the end, that's what we got. Initially, there was a sense that, this is good news if inflation is cooling, and gives the scope for the Fed to cut interest rates again at some point during the year, but it didn't really move the needle that much in terms of rates pricing, and I think it's because, the market needs to see much more evidence that that's the case before it gets too excited about the idea of the Fed moving again. So we're still priced for those 2 cuts this year, one in the first half, one in the second half. There is, though, that sort of counter-argument that we heard from JPMorgan's strategist talking about the idea maybe the Fed is done cutting and the next move will be a hike, as we were just hearing. And some of the options market bets are starting to show that same thing. So there is a little bit of concern that maybe the Fed won't be able to do as many interest rate cuts as was previously hoped. And so that's holding things back just a little bit at this moment in time. But I do think overall, again, as we were hearing, the US economy is looking in pretty good shape at the moment. JPMorgan described a kind of, Jamie Dimon was describing a kind of Goldilocks scenario almost. He said that, yes, the labour market isn't looking great, but it's not looking any worse. And the rest of the economy is ticking over very nicely at the moment.
Paul, talk to us about some of the price action we've seen in Japan. It was a stellar day for the Nikkei yesterday. It looks like the market's not only decided, is this snap election happening? Takaichi is already a lock to win it. They're getting a bit ahead of themselves here.
Well, I think Takaichi is incredibly popular at the moment and riding that wave, and enjoying herself by the looks of it. I enjoy following her Twitter feed. She had one out. She was behind the drum kit along with South Korea's president the other day, all smiles, and sort of is tapping into that sort of youth vote as well as the more established votes in Japan. So it is good timing from her perspective to call an election. I think the market loves it and hates it at the same time. Likes it and loathes it, maybe, because that Takaichi trade isn't just about the idea that she will do more fiscal stimulus and that will be supportive for the stocks market, but it's also about the idea that she will do more fiscal stimulus and that will cost more money and hurt the bonds market. And we did see another big increase in Japanese government bond yields at the same time as equities were rising. We're also seeing pressure on the yen, which is getting ever closer to 160. So it's not a cut and dried all over positive for financial markets. And in fact, probably the thing that has the most potential to have a global impact would be if those JGB yields do continue to rise and that ripples through the rest of the fixed income universe.
So are we expecting further upward pressure on JGB yields, more to go on the weakness in the yen? What's the risk of reversal there?
I think it definitely feels consensus that JGB yields are going to continue to rise. That was a trend we saw throughout last year. What matters, I think, is the pace. If we see panic and a sell-off that really pushes yields up rapidly, then that's going to be quite hard to contain, could be self-fulfilling. On the other hand, what we are seeing is more and more of the life insurers are more attracted by the yields as they rise, looking to pick up some more exposure to Japanese government bonds, maybe repatriate some money from overseas. And so that's helping to moderate things a little bit. And we're also seeing overseas investors who, once they've done some currency swaps, actually get very favourable yield pickup from the Japanese government bond market. So that's also helping hold things in check. But the situation is a little bit fragile right now. And so how Takaichi calibrates those spending plans and communicates them is actually going to be really important for the bond market.
All right, Bloomberg Executive Editor for Asia Markets, Paul Dobson there. Coming up on the Asia Trades, Westpac shares their expectations for the Fed after that soft inflation reading. We'll talk market strategy with UBP and Capital.com. Also a check on the health of China's consumer recovery live from the UBS conference in Shanghai. All that coming up. This is Bloomberg.
If you ask me, in the short run, call it 6 months and 9 months and even a year, it's pretty positive. Consumers have money, there's still jobs, even though it's weakened a little bit. There is a lot of stimulus coming from the one big beautiful bill. Deregulation is a plus in general, not just for banks, but banks will be able to redeploy capital. But the backdrop is also important, but the timetables are different. Geopolitical is an enormous amount of risk.
JPMorgan CEO Jamie Dimon there, upbeat on the US economy. And of course, we did get those CPI numbers coming in pretty much in line as expected. In fact, core CPI a little bit softer than anticipated. But the key question is, what does all of this mean for the Fed in 2026? Well, we see the market there still pricing in 2 cuts by year end, reinforced by that softer inflation print. Worth mentioning that JPMorgan, for its part, doesn't see any cuts at all in 2026 now. Joining us now is Illiana Jain, international economist at Westpac. So, Illiana, against that backdrop, are we setting up for a repeat of 2025 here, where the market expected a lot more easing than it ended up getting?
Yeah, so our central expectation is for one more cut in Q1 and then easing from then on out. Now, those inflation print that you mentioned did say that perhaps inflation isn't going to be quite as high as everyone anticipated. We're starting to see that pass-through of tariff impacts into inflation starting to ease. So that core goods component came in flat. And that's really saying that tariff inflation perhaps might not be as high as we anticipated. The other key thematic that we saw in the inflation numbers was that we saw car prices decline quite dramatically. And that really reflects a lot of the exports of Chinese vehicles. This isn't something we've just seen in the US. It's been a global phenomenon where we've seen a lot of declines in car prices coming from China. And that speaks to a broader story of China exporting a lot of its deflation, and that's likely to be a downward pressure on inflation in the US and globally for the course of 2026.
So we've got a situation here where inflation's looking pretty good, heading towards targets. The unemployment rate actually went down. JPMorgan quite upbeat on the growth outlook as well. Does this really look like an economy that needs a supportive environment, that needs rate cuts?
Yeah, so we are a little bit on the hawkish side by just saying one more cut. But on the labour market figures, as you pointed out, we did see unemployment rate go down. But it's important to note that a lot of that came from people exiting the labour market, not necessarily because we saw a sharp uptick in employment. That jobs number, we also did see fewer jobs being created in the economy. For growth for 2026, we are envisioning that capacity constraints are going to weigh on growth, and that's going to see growth come in softer than it did in 2025. Through the course of 2025, we saw a lot of investment, business investment, but a lot of it came into AI and tech-related fields. A lot of that capital investment was nowhere to be seen. So as we see capital depreciate and as we see a lack of capital investment excluding AI, it's going to mean that there's more capacity constraints in the economy. And that's really only going to add to the capacity constraints created by the immigration policy in the US and what that means for labour supply there as well.
Would you say, Illiana, that the tariff noise and perhaps the government shutdown, distortion of data is safely in the rear view mirror? Should we still be worried about this tariff pass-through?
Look, I wouldn't say it's in the rear view mirror, but it's something that has a bit more downside risk than we previously anticipated. So like I said, goods inflation came down, and we're starting to see a lot of manufacturers talk about how costs are high, but they're not accelerating. I'll be keeping a close eye on the import price index tonight, as well as the PPI tonight, to get a gauge of what producer prices look like for manufacturers and whether it means that they'll have to pass on these costs to consumers and see that inflation come up.
What are you seeing in terms of productivity and the outlook there in the US? You alluded to some of this with AI a short while ago.
Yeah, so AI will definitely be a boost to productivity, as it will be for most of the world. However, one thing that's constraining some productivity in the US will be that capital investment. So in the absence of physical capital, people investing into physical capital, it means that labour to capital ratio is likely to be a little bit off, and that's also going to mean that productivity might be a bit softer. With a lot of the labour shortages as well, we can anticipate some productivity declines through the course of this year, even as AI supports other parts of the economy.
There's some other factors here as well. We're seeing wages finally catching up to CPI in the US as well, but at the same time, consumer confidence isn't fantastic. It's hovering around post-COVID lows. Why is that? And do you see it picking up?
Yeah, it's definitely a really interesting picture. So the figures yesterday, we saw real average weekly wages rise 1.1% in the US. So for about a year, we've had consumers have real wage gains. Now, despite that, consumers have definitely been quite pessimistic. Now, it isn't difficult to see why. It's a very uncertain environment in the US. Policy keeps changing, whether it be around businesses or trade. And even if consumers are experiencing real wage gains, they're still going to be quite hesitant about their future and including their future finances if they don't know if they're going to have a job because of these policy changes.
We do need to ask you, before we let you go, about Fed independence and whether or not you have any concerns there. It looks as if the market's been shrugging off this investigation of the renovation at the Federal Reserve. Are you confident that whatever happens, the Fed will still be data dependent?
Look, they've come out and said that they're looking to conduct monetary policy in an independent way. We saw the statement from Chair Powell supporting that. In addition to that, we've seen central bank governors from the ECB as well as the Bank of England come out in support of Powell. The Fed knows that in order to make monetary policy effective, they have to appear as independent as they can. That is how policy is effective. So we think they'll be sticking to their guns and trying to make independent decisions based on data.
All right. Illiana Jain, international economist of Westpac. Thanks so much for joining us. And we have more ahead on the Asia trade. This is Bloomberg.
The top global headlines we're following. Japanese Prime Minister Sanae Takaichi says she's seeking closer economic security ties with South Korea as she seeks to contain a diplomatic dispute with China. Speaking after meeting President Lee Jae-myung in Nara, Takaichi said they also discussed supply chain cooperation without elaborating. Lee says he emphasized the need for common ground between Korea, Japan, and China. South Korean prosecutors are seeking the death penalty for former President Yoon Suk-yeol over his botched 2024 declaration of martial law. A verdict is expected next month, with Yoon facing the prospect of either a death sentence or life in prison. Yoon was indicted last year on charges of insurrection after he shocked the nation and the world by briefly suspending civilian rule. Prosecutors in Taiwan are stepping up efforts to block China's tech players from recruiting the island's talent. They've issued an arrest warrant for Pete Lau, the CEO of Chinese smartphone company OnePlus, and indicted 2 Taiwanese citizens who work for him. OnePlus is suspected of illegally recruiting more than 70 engineers in Taiwan. We have more ahead on the Asia trade. This is Bloomberg.
President Trump has urged Iranians to continue protesting against their government, promising that help is on its way without specifying what that means. Activist groups say thousands of people have now been killed since the protests began.
To all Iranian patriots, keep protesting, take over your institutions if possible. Help is on its way.
President Trump is expected to meet with his National Security Council soon to discuss the situation. Let's get to Washington and Bloomberg's Julie Fine. Julie, do we have any idea of what potentially could be on the table here? And also there's a risk as well that potentially US involvement could end up sparking a wave of nationalism, perhaps strengthening the hand of the theocracy.
Well, we don't know exactly. We know that the president has talked about the importance of Iran in supporting its people. Now the question is what the U.S. does next. If the U.S. does go ahead and consider military strikes, there are many in Congress that have raised reservations about this. The president also telling the protesters in Iran help is on its way. The question is for them, what do they do? Because they don't know exactly what the help is. Now, on top of that, there is a whole messaging issue there. There is a communications blackout. So for the protesters to even speak to each other right now outside of their immediate area, that's a whole other issue. So right now we are told that the president is mulling his options as this situation intensifies.
As he continues mulling those options, what is the sense we're hearing from observers in terms of whether the U.S. is back in the business of regime change?
Well, that's certainly a question that a lot of lawmakers are facing right now, especially in the wake of what just happened in Venezuela. So there are some lawmakers that are certainly exercising caution here and are expressing concern right in that mindset because of what we just saw happen.
We've also hearing from Elon Musk potentially making Starlink communications available to Iran for free. What are the logistical challenges in doing this, though?
The logistical challenges really are getting it up and running as soon as possible. Again, there's that communications blackout there, which is causing major problems for the people there and the economy. So Elon Musk, of course, with that offer, but now he's got to get that up and running. That's not going to be in 20 seconds. It's going to take some time. But he has expressed his commitment to the protesters there in this. There's also the question now of Elon Musk and President Trump working together. Those two, of course, were very close throughout the campaign. Elon Musk heading up Doge, and then Doge really, becoming much less significant than it was, and Elon Musk in Washington much less frequently. But now you're actually seeing a warming up of the two in this situation.
Yeah, Julie, those two have a pretty complicated relationship. Thank you for talking to us through the latest on Iran, Bloomberg's Julie Fine. Let's take a look at how Japan assets are faring in the early goings, of course. We saw just yesterday that immense weakness in the yen. We are on intervention watch. Some say 160 is the level to keep an eye on. Don't forget, that is when in 2024, finance authorities actually pull the trigger in terms of intervening in the market around the 160 level. Futures pointing to further upside, and certainly we already saw those record highs on the topics and Nikkei just a day ago. The pressure seeping through still on JGB futures. Joining us now is Zuhair Khan, Senior Portfolio Manager at UBP. So Zuhair, great to see you. And looking at what the Japanese stock market outlook is, it looks quite bright. I mean, the pro-growth expectations from Takaichi. What is your sense of whether we have more upside on Japanese stocks?
So I think the Japanese market overall is fairly valued. If you exclude one thing, which is continued significant corporate governance reform, excluding that, it's fully valued. But there are a lot of Japanese companies which have not yet benefited from corporate governance reform. I mean, 60% of Japanese companies still have close to 20% of their balance sheet in cash. A large majority of Japanese companies still have loss-making, unprofitable business segments. And then you have a significant need for consolidation in the Japanese market. There are too many companies in the same industry, each of which are subscale and not very profitable. So consolidation would tremendously benefit the market. So if those things continue to happen, there is upside without, let's say, an acceleration of those things. Because part of it is priced in, I think the market is fairly valued.
Okay, what about
again, one thing I would like to highlight is that, sorry, I was just going to say one last comment, which is that relative to global markets, the Japanese market, even though I think on an absolute level it's fairly valued, on a relative level it remains very attractive among other major global markets. Sorry, you had a question on yen.
How much are you expecting foreign investors to then, turn their attention to Japan? And given the yen volatility, does that figure into the attractiveness of the market?
So I think given how weak the yen is currently, I think for foreign investors, that's an added attractiveness of the Japanese market, because I think the yen is undervalued and over time it should recover. The pace and timing of that is difficult. It'll depend more on Fed loosening policy rather than the BOJ tightening, because the BOJ is going to tighten at a very slow pace. And then it's also going to depend a bit on sentiment. So a lot of Japanese continue to invest overseas, very significant amounts to the new investment savings account, NISA. A lot of that money is going overseas. Japanese companies, because the yen has continued to remain weak, have not been repatriating their profits back into Japan. So if you start to see a strengthening, I think those factors may start to reverse and then add to the trend of yen strengthening. But I think it'll depend more on Fed moves rather than BOJ moves in the near term.
So we've got this environment of very weak yen, closing in on 160, weakest since July 2024. And at the same time, we've got yields climbing as well. Now, we've got some commentary from Carlyle saying, look, this is a good sign. The economy's exiting deflation. But is that really a sign of economic health when you look at that sort of trend? Any reason to be concerned?
No, I completely agree with them. If you look at the 10-year Japanese inflation index bonds, the real return on those is only 0.22% currently. It's less than 0.3%. If you compare that, for example, to the German interest rates, the real inflation protected interest rates, it's about 1%, just under 1%. If you look at the US, UK, France, it's between 1.5% to 2%. So Japanese real interest rates, inflation protected, remain very low. So I don't think that's an issue. And in fact, Japanese inflation is actually helping the government currently on the debt to GDP ratio, right? So nominal GDP is growing faster than the debt is growing. And so the nominal debt to GDP is actually declining. And I think that remains well under control. I think what happened until this past year and the later half of last year was that as global inflation was declining, people expected that Japan's inflation, which was running at around 3%, would decline and Japan would go back towards zero inflation. And hence the Japanese longer-term bond yields were not going up. But what they've seen is that Japanese inflation has remained quite sticky and strong despite global inflation declining. And so that's given people confidence that Japan is truly out of deflation. And that's why the longer-term bond yields in Japan have been going up.
Do you see any upside risk to inflation from the yen pushing up prices of imports?
Yes. And this is a big political problem for Takaichi. I mean, this is why her predecessor, Ishiba, basically had to step down, was because people were unhappy with inflation and the cost of living in Japan. So it's something that she needs to tackle. She has other political issues as well, but it also, there's an opportunity. There's recently, rumors about she may call for an early election. That may be a positive for her, but there are, of course, risks whenever you go into an election.
Zuhair, talk to us about the sectors that you are perhaps a bit more cautious on given the valuations, tech, financials, for example.
Yeah, so I think the rising interest rates are more than priced into financials, especially insurance companies and banks and regional banks. Not as much the mega bank. Mega banks are maybe a bit better, but regional banks, insurance companies, I think rising interest rates are more than priced in. A lot of, let's say, inbound thematic names like restaurants, department stores, I think are overvalued. The tech names, I think, are overvalued. Defense-related names has been a big thematic this past year in Japan. That's overvalued. There's been a bit of an AI mania in Japan, and I'll give you one sort of example of an AI mania. So until earlier, let's say middle of last year, late last year, Japanese factory automation names were considered sort of a bit negatively because there wasn't a strong rebound in demand from China because of the involution policies of the Chinese government to reduce capacity. But then suddenly it became, robotics is the next AI, factory automation is the next AI name, and those just bounced up like crazy. And then what you see is as they're reporting earnings and outlook, there's no improvement. And it was just that, robotics is the next AI and the valuation ran up. So there are those sort of thematic sectors that we need to be quite cautious about.
Do you see that caution also part of the function of the way in which South Korean markets, we've been seeing that robotics theme also playing out there. Does it sap some of the investor appetite at a time when memory prices are trending at these levels? That seems to be supportive more of South Korea, big chip makers, rather than the other electronics makers across the region.
Yeah, so I think, this theme has become rather, when we look at, let's say, even the more bullish forecast, for example, for many of the Japanese component makers or companies in the semiconductor supply chain, and we look at the more bullish forecast, and then we price those in, using a discounted cash flow model, we still can't explain current valuation, right? So even using the most bullish forecast. So I think there's a bit too much priced into the market currently.
All right, Zuhair Khan, Senior Portfolio Manager at UBP. Thanks so much for joining us today. We have more ahead on the Asia trade. This is Bloomberg.
Bloomberg has learned that Netflix is working on revised terms for its Warner Brothers bid and has discussed making an all-cash offer for the company's studios and streaming businesses. Bloomberg's Chris Palmieri leads our media and entertainment coverage and joins us now from LA. So, Chris, another day, another development in this takeover saga. How much sweeter does this all-cash offer potentially make things for the deal?
Well, we're not hearing that they're actually raising their price, which, if you remember, is $27.75, but it was basically about $23 in cash and $4.50 or so in Netflix stock. And what's happened is, since this whole thing began, Netflix shares have fallen. They've lost about a quarter of their value. And Paramount, which is definitely wants to thwart this deal, has been hammering Netflix, saying that their shares are falling and you're getting less. And so this definitely addresses that there's more certainty now for the investors in Warner Brothers are getting all cash from the Netflix deal.
Well, Chris, if one thing this saga has taught us, it's that Paramount will almost certainly have something to say about this or some sort of response. What might we anticipate?
Well, they already had a big response yesterday with a lawsuit and threats of a proxy fight. Their strategy from here is they've asked for an expedited hearing of the lawsuit. They're trying to get more details about how Warner Brothers figured out the calculations for the Netflix bid. They're trying to get as many shareholders to support reopening talks with Warner Brothers or thwarting the Netflix deal should it come to a shareholder vote. And if it ultimately comes to an annual meeting, then they would potentially propose their own slate of directors. So still a lot to come from Paramount.
For Netflix, though, in financing something like this, what are we hearing in terms of whether it could soon run out of constraints and up the offer?
We didn't get an exact number in terms of borrowing, but if they did that $4.50 that they were offering in stock in cash instead, that would be about another $11.6 billion. Bloomberg Intelligence put out a report after our report today saying that Netflix has the borrowing capacity to do that and not impact their credit ratings. So they were already looking to borrow about $54 billion for this deal. So that would add potentially another $11 billion or so more.
All right, Bloomberg's Chris Palmieri there. Let's get the latest from the corporate front now. Morgan Stanley has increased bonuses for its bankers in Asia and Europe after a bumpy year driven by trading and deal making. Bloomberg sources say payouts in Asia rose by about 2% after the firm closed in on a record $10 billion in revenue from the region last year. Meanwhile, investment bankers in London reportedly received a 10 to 15% bonus hike, while deal makers in Europe got as much as 15% more. Bloomberg has learned that Rio Tinto is bringing in a slate of bankers as it pursues a deal for Glencore. Sources say they include top UK rainmaker Simon Roby of Evercore, as well as JPMorgan and Macquarie. Citigroup is also said to be in talks for a role after its involvement in many of Glencore's recent transactions. Boeing sold more jets than Airbus last year, snapping a 7-year losing streak as it recovers from a difficult period of corporate crises. The US firm booked 1,175 orders for the year, including a Qatar Airways deal that is the biggest in the company's history. Boeing also delivered 600 planes last year, capped off in December with its best monthly showing of the year. More ahead on the Asia trade. This is Bloomberg.
Japan's JFE Steel says it expects India's steel industry could overtake China's in the long run. Executive Vice President Hiroyuki Ogawa spoke to us exclusively after JFE announced last month it was investing $1.7 billion in a joint venture with India's JSW Steel.
India's steel growth rate is said to be around 8%, so there is great room for us to enter and expand here. Previously, the Indian economy experienced major growth in areas different from typical economic growth, such as IT. But with a population of 1.4 billion, there is huge potential. With infrastructure expansion, steel has a very significant importance. This is why we are focusing on this market. The Indian government is aiming for a very large production volume of 300 million tons by 2030.
Do you think India's steel market could eventually overtake China's and become the world's largest?
China currently has an enormous production capacity of around 1 billion tons. But since India's population has surpassed China's, if you look at the truly long-term future, I believe it is certain that India will become the world's #1 steel-producing country.
Other foreign steel producers are scaling up their investment in India. Do you JFE aim to position your company as the top international steel maker in India?
Of course, we are aiming to be #1. Our focus is that India's growth is extremely rapid. While competitors are naturally considering expansion in India, we believe there's ample room for mutual competition. Crucially, our strength lies in JSW's exceptional execution capability and high investment implementation rate. This is evident in our past expansion speed. They execute with a sense of urgency, accomplishing in 3 or 4 years what others take 4 or 5 years to achieve. On the other hand, we have a long history in Japan, having experienced high growth and then transitioned into high value-added production. By combining our experience with JSW's execution capability, we can build a competitive advantage and become the #1 steel manufacturer in India.
JFE's the current midterm business plan, the 8th one, allocates roughly 400 billion yen for overseas steel operations. Is India the only emerging market you are prioritizing, or are there any additional regions under consideration?
While we're not solely focused on India, when you mention emerging markets, India is undoubtedly the most important market for us right now. We're also interested in the US. One question is whether we can do something in the US. Then, looking beyond that, where exactly will the next growth area emerge after India? We're all looking at the world map and considering possibilities, but we don't have an answer yet.
That's JFE Steel Executive Vice President Hiroyuki Ogawa speaking there with Bloomberg's Yosuke Mekawa. Let's take a look at how markets are tracking here in Australia after the first hour or so of trade. Not quite now. We're pretty flat at the moment. Energy stocks performing the best right now. We have had oil climbing to a 2-month high around uncertainty in terms of what's happening in Iran. President Trump saying he's urging Iranians to continue protests, although we don't know what potentially the US response could be at the moment. One stock we're watching at the moment, BlueScope Steel on the bottom of your screen now, creeping higher by 1/3 of 1%. This is after announcing it's going to be making a special dividend, $1 per share. That's going to be paid on February the 24th, although BlueScope's saying that this really isn't about keeping shareholders happy after knocking back a takeover bid last week. It says this money is from a sale of a stake in Tata BlueScope, which yield $176 million. So that special dividend, 438 million Aussie dollars in cash. Looking ahead to the start of trade in Japan, Nikkei futures better by about 1/10 or about 1/4 of 1% at the moment. After a stellar day yesterday, the yen still pretty weak, knocking on the door of 160. Avril.
Yeah, we're watching out for potential intervention, even though the yen has been stabilizing a little. Now, what we have been seeing also in terms of Northeast Asia currencies that have been weakening, the Korean won, and this is against the backdrop, of course, of very interesting moves when it comes to retail investors. Despite the climb you've been seeing in the South Korea stock markets, they still seem to be seeking opportunities abroad, channeling funds elsewhere. So when you look at the won, it's actually on its longest losing streak since 2008. Does this complicate things for the BOK? Tomorrow, expected to keep things unchanged, but don't forget how Korea won's weakness could feed into this import inflation. And we are also digesting the jobs numbers that we got out of South Korea at the top of this hour. 4% jobless rate. This is much higher than expected. It speaks to the cracks, perhaps, in the labor market and a split track, a K-shaped economy that's fueling these chip-related sectors, but not so much construction activity, for example, and other domestic sectors in the economy. Let's also take a quick look at what else we are looking at in the yuan moves. Of course, yesterday we saw it snap a winning streak, given the moves in the greenback, for the moment holding out at the 697 level. Markets open next in Seoul and Tokyo. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens. And Paul, it was about the data overnight, how the US core CPI cooling, the optimism surrounding that in terms of Fed rate cut bets didn't last terribly long. In terms of data in the Asia session, we also had just a short while ago in the past hour, those South Korea jobless numbers, cause for concern, no doubt, for the likes of the BOK, which of course comes through with a decision tomorrow.
Yeah, those CPI numbers out of the US, they did cause an initial pop for stocks, but then we saw a bit of a pullback after the JPMorgan results. We'll get a little bit more on that in a moment. But yeah, we're counting down to the open in Japan, and let's see if that incredible rally can continue.
Yeah, not forgetting, right, what the bets are telling us in terms of the chances for an early election from the Takaichi administration. And we're hearing from local media this growing chorus of media reports that, you know, we could, as soon as today, see her announcing this intent to dissolve the lower house of parliament. Of course, this is a key step towards calling that early election. Now, we are, of course, seeing how the Japanese gauges in the past day, to your point, reached those record highs. And this was fueled by, yes, some of the sectors that could benefit from expansionary fiscal policy if Takaichi gets a clearer mandate to pursue those very policies. We are also seeing how the weakness in the yen supported those export-related names just a day ago, although the voices in the business community about the yen volatility also do sound a bit louder. 10-year yield on Japan still nudging higher, almost towards that 2-2 handle. We do have a 5-year auction later today to get through as well. Take a look at South Korea. What's been interesting there is the upward trajectory we've been seeing in stocks. But despite that, and though it's taking a bit of a breather for the moment, how the South Korean won has been weakening along with those stock market gains. So does this speak to how investors are still channeling their funds abroad, and maybe also the narrowness of the rally in South Korean markets? Keep in mind, we also got those jobs numbers, as I mentioned a short while ago, Paul.
Well, let's take a look at how trade and US debt is tracking at the moment, because we did see a bit of movement in the short end of the curve after those CPI numbers, both the 2- and 5-year notes falling about 3 basis points, with CPI coming in pretty much in line, core CPI softer than anticipated. But take a look at the yield on the 10-year, unchanged. It's been kind of marooned there most of the week in that range, 4.1792 at the moment. The 2-year also seems to have found a floor. We've got S&P futures, meanwhile, also looking pretty flat. We haven't really talked about the oil price today. That did initially climb to a 2-month high. President Trump urging Iranians to continue protesting, says Iran very much on his mind, without really specifying on what might happen next. President Trump saying he is consulting with allies on Iran. Well, joining us now from Melbourne is Kyle Rodda, Senior Market Analyst at Capital.com. And Kyle, I do want to start with what we saw in terms of those CPI numbers out of the US. Really hotly anticipated data print, the first clean set of numbers we've had since the US shutdown. Core CPI was weaker, I guess, is the key takeaway here. Did you see anything in the data that suggests the Fed should continue to be cautious on inflation?
Well, I mean, if you look at things on an absolute basis, inflation remains anchored in this kind of high 2% range. And even though the numbers was a little bit softer than expected, there is still a high degree of noise in the figures, and not strong enough evidence, I think, that inflation is coming back down to the 2% target, that the Fed can be, very confident in cutting interest rates in the immediate future. Of course, we're now looking at an extended pause, with really the question now to what extent disinflation continues, more from supply side factors, that is productivity in the year ahead. And a lot of that's tied up into the artificial intelligence trade and story at the moment too. So obviously it's promising numbers, not to see inflation accelerate here. There continues to be the risk that that is something that will happen in the future, given some of the action that we've seen in commodity prices recently, and also this almost profligate fiscal settings that we're seeing around the globe, but also the United States. But for now, it's wait and see from the Fed. 2 cuts are obviously priced in for the year for Fed policy. It doesn't appear that that's going to be much of a tailwind for risk assets from here, but nevertheless, the inflation data was positive without really assuaging those concerns that inflation is completely back under control.
Yeah, to your point on the Fed, you say the market is still pricing in 2 cuts. As the year continues, do you have a sense that maybe that might turn out to look a little bit optimistic? Because this is what we saw in 2025. The market expected a lot more cuts than it ended up getting. JPMorgan now sees none at all. Other major banks are pushing out their timeline as well. But we do have a new Fed chair arriving later in the year. Would a perhaps, a Trump appointee, another one, Jay Powell's a Trump appointee, make a difference here? And do you have any concerns about Fed independence?
I think everyone has concerns about Fed independence at the moment, and clearly, the fairly unprecedented steps over the last week to effectively threaten the head of the Federal Reserve with, criminal charges and practically jail time to try and strong-arm the institution. That's going to be a problem that will manifest in obviously rates at the longer end of the curve. But obviously, policy is set by a committee. We've got obviously Myron likely to, he'll leave the FOMC in January. The complexion is still reasonably well balanced between serious policymakers who are going to be looking at the data in particular to set policy from here. The concern is that because we've still got a fair degree of strength in the US economy and still inflation running at these current levels, is that the full extent of the rate cutting cycle from here, even if the Fed does cut 2 more times, is already baked into the market, so that it will no longer really influence the direction for travel for equities. It will no longer be a sort of downward pressure on the US dollar, for example. You throw on the flip side of that there is still a very strong impulse, obviously, within the White House to continue to run the US economy hot. That raises the possibility of continued demand-side factors pushing inflation higher. And really, it becomes, as almost the Fed told us at the end of last year, a bet on continued very strong productivity growth, some of that being related to artificial intelligence, that we get disinflation through, and both that kind of Goldilocks economy of strong growth and disinflation. So it's to say that, basically the threats against the Fed are very concerning. It doesn't necessarily mean that there will be much more dovish policy as a result, but all of that is priced in and likely to be less of a tailwind for equities going forward.
Affordability seems to be a key theme for Donald Trump this year. Is there a way to position around this?
Affordability, is that what you said?
Yes, affordability. I think he is perhaps more cognizant of these cost of living pressures in a year where we are going to see a midterm election.
Yeah, certainly. I mean, it's a factor, but the thing is that, you know, these policies are kind of half-baked and sort of harebrained in many respects because they're going to have second-order effects. I mean, you look at what's happening in terms of the interventions into the housing market, supply risk, even if there are sort of, you know, certain merits behind a policy of keeping institutional investors out of the housing, single-family homes. And then, you know, you look at what's happening in terms of credit card debt. That might have a short-term impact on households through lower interest payments, but obviously that's going to affect the supply of credit. It's not going to really be on something on aggregate that makes anyone sort of, you know, better off. The other side of that too is that you have to look at these things on the aggregate and what the Trump administration is actually doing in terms of policy at the moment, and it's running deficits of 5 or 6%. And we're also talking about situations here where either we could lose tariff revenues because of the interventions of the Supreme Court. That opens up a big question. And then on top of that too, there's also to talk about whether future tariff revenues will be used as subsidies for households. Trump likes to spend money. Trump likes deficits. Trump likes running the economy hot. There are these, this rhetoric about getting, the affordability under control. But if you look at real policy settings, that's not what the administration is really going to achieve here.
Does all this, though, revive what investors call the Sell America trade? And to what extent does that then turn the attention even more this year into Asia?
Well, if you get the Sell America trade coming through, I fear that it would manifest in significant tightening of global financial conditions, largely due to the impact on US debt and higher rates and that risk premium being baked in. I think the Sell America trade has probably, at least for now, been fully discounted and is a little less relevant this year than it is for the last year. And I think the dollar will actually express that a little bit too, notwithstanding also the fact that I think we're at the absolute ends of the market's pricing in the rate cutting cycle from the Fed. There's also the view that the Trump effect on US assets, although still structural and to play out in the longer term, a lot of that has sort of been priced in. The point there with what's going on in Asia in particular is that if we do get that kind of concern about trustworthiness in US assets, that's probably going to manifest in treasuries, that's going to slip through into valuations, into equities, that's going to put pressure on financial conditions around the world, and that's going to spill over into other markets, including Asia as well. I would say if you want to play that trade, it's not about allocating into other areas of the equity market, it's about allocating towards things like precious metals and things with physical constraints on them. We're seeing that already manifesting in some areas of the commodity markets. That would be the play on a loss of faith in US institutions, probably not a rotation from one equity market to the next.
Kyle, I just do want to get your view on one of the other news stories we saw today, JPMorgan losing some ground today after those results, a bit of disappointment in terms of investment banking returns. But if we take a look at this chart, we see that all US financials are softening, and you could say it's on this news that President Trump plans to cap credit card interest, not really being supportive. Now, JPMorgan, Jamie Dimon says everything's on the table to fight this. Now, I do wonder, if you're a believer in the taco trade, do you see a buying opportunity for US banks?
I would re-anchor it in earnings and earnings expectations, because this will be obviously really significant. And if this sort of taco trade plays out, then obviously Trump will back off. And there's kind of the sense that maybe some sensible heads within the administration, I think market participants often, sort of pray for Scott Bessent's interventions here as someone who's fairly clever, fairly sober, and seems to have the president's ear when it comes to these sort of more extreme policy measures, might back off, and that would sort of obviously remove one significant tail risk and headwind to future profits for the banks. What I would say, though, that again, this is embedded in a broader earnings story, and one of the reasons obviously JPMorgan sold off last night was because of that warning about what the policy of capping credit card rates would do to future profits. But there was also a disappointment about guidance in certain segments of the business, and that sort of ties back to this view of investors and analysts expecting profit growth that, if not won't be achieved in the year ahead is certainly fully priced in, and that the bar for upside surprises is reasonably limited from here. So that's a valuation question. I think that's far more important. We got that shock from JPMorgan last night. We've got more banks coming up in the next 24 hours. That'll tell us whether the earnings outlook is good or not. That is far more important. That kind of high bar set for companies, the banking sector included. And I suspect that will be a theme that persists far beyond this period, and this kind of potential concern around what's going to happen with credit card rates.
Kyle, always good to hear your thoughts. Thanks so much for your time today. Kyle Rodda is Senior Market Analyst at Capital.com. Now let's take you now to Nara, where the South Korean President Lee Jae-myung is touring Horyuji. This is a historic Buddhist temple and landmark there. And of course, he is on that 2-day visit to Japan to meet with the Japanese Prime Minister Sanae Takaichi. Now, they have been exchanging views in terms of stronger ties, economic security, and all this coming against the backdrop of that Japan dispute with China. So you're seeing there Lee Jae-myung touring Nara. More ahead on the Asia trade. This is Bloomberg. Spotlight on Japanese assets this week is about the revival of the Takaichi trade amid these local media reports that we could soon see an election called by the Japanese Prime Minister and perhaps give her a clearer mandate to pursue pro-growth policies. We are seeing the Nikkei extending the gains from yesterday, which was already at a record high, and the weakness in the yen seems to be supporting those export-related names. JGBs still under pressure. In terms of government debt auctions, we have a 5-year later today as well. Let's get more from our Japan politics and economics reporter Sakura Murakami. Sakura, there's a lot of speculation, but maybe talk to us first about what's at stake for Takaichi if she does indeed call a snap election.
So this would be a bit of a political gambit for Takaichi. She does have very high popularity ratings. Sometimes they even touch up to 80%. They kind of are around the 70% mark recently. And it would be a kind of a bit of a gambit for her. But on the risky side of things, it would be a bit of a difficulty because it would be seen that she's putting inflation on the back burner. If she does call an election, the budget will probably be passed at a later date, and that could be seen as a bit of a problem. Also, there are reports that seem to say that she's not quite solidified her power within the LDP. So there are pros, there are cons, and she's trying to call a gambit at this point.
Yeah, and to your point, I mean, we only have reports that she intends to call an election. It hasn't actually been called yet. So what's the state of play? What are the variables?
So at the moment, Prime Minister Takaichi is hosting South Korean President Lee in Japan. There are also plans for Prime Minister Meloni of Italy to visit later this week as well. So the expectation is that she's not going to mention a snap election. She's not going to really talk about a potential dissolving of the parliament quite yet until later this week. But after that, the expectation is that the parliament will be called into session next Friday, and that could be an opportunity for her to test the waters, possibly call the election, and in that case the election will probably come sometime around early February.
If she does dissolve Parliament, it'll be a first for her since she came to power in October. What might be different this time around?
So yeah, given this is the first time that she's kind of heading into a lower house election, it'll be the first time that she can actually seek a public mandate for all of the policies that she put forward during her election campaign to become the leader of the LDP. That being said, the kind of context of things, the political dynamic of things has changed significantly since October, especially with the exit of the LDP's former junior coalition party Komeito. They had a strong electoral cooperation going on there, so they would be the first time in over 20 years that the LDP is heading into the election without the support of Komeito. They now have another junior coalition partner, the Japan Innovation Party, but how that dynamic plays out with them is still an unknown. So that's also part of the risk that Prime Minister Takaichi will have to face if she does call a snap election.
All right, Bloomberg's Sakura Murakami there in Tokyo. Well, Prime Minister Takaichi is also pushing for closer economic and security ties with South Korea after hosting talks with President Lee Jae-myung. That's as she seeks to contain diplomatic and trade tensions with China. So for more on this, let's get to our East Asia government editor, John Herskowitz, also in Tokyo. So, John, what have the two discussed so far?
Sure, we got what you kind of would expect. They discussed deepening economic security cooperation, supplies of critical minerals, supply chains, and keeping the shuttle diplomacy going. But the main thing is the backdrop for this meeting. Lee Jae-myung just came from China, where he was courted by Xi Jinping, who was trying to drive a wedge between Japan and South Korea. China has been quite angry about some of the stances that Prime Minister Takaichi has taken towards Taiwan, has put economic pressure on Japan, and has played to some of the things which are part of Lee Jae-myung's Progressive Party's base. They've taken hardline stances on Japan for past colonialism of the Korean Peninsula, and also that they've tried to really put pressure, tried to drive a wedge between the two. And for Takaichi, this was a chance to show that relations with Korea are on an even keel. Lee Jae-myung went into the meeting, said that relations with China are just as important with relations with Japan. And the optics of this were that Lee Jae-myung shows good relations with China, good relations with Japan, and the three countries also have economies that are deeply meshed. So they're all kind of walking tightrope balancing acts when it comes to this. And so what came out of it was expected. The backdrop is much more important in how this progressed with what has gone on over the past few weeks.
Yeah, John, given the talks between Yi and Takaichi, what might not just China, but I guess the US as well, take away from all this?
Sure. From the U.S. perspective, its two biggest and most influential partners in Asia are Japan and South Korea. The bulk of U.S. troops are positioned in these two countries. Any security contingency is heavily dependent on what goes on in those two countries, whether it's with North Korea, China, or with Taiwan. For China, they were perhaps looking to see if their courting of Lee Jae-myung worked, if they were able to actually put some distance between Tokyo and Seoul. So, they're looking at this from different perspectives. The U.S. seeing if it could keep support from its two key partners. They need South Korea and Japan for securing supply chains that are less dependent on China. And China was hoping to make some inroads with Lee Jae-myung. So both of these global powers were looking at this meeting quite closely to see the outcomes from it.
John, thanks so much for putting things in perspective for us. Bloomberg East Asia government editor John Herskowitz in Tokyo. More ahead on the Asia trade. This is Bloomberg.
Yeah, the message is they've got to show humanity. They've got a big problem. and I hope they're not going to be killing people. And I'm going to have a report very soon. Ideally, you'd like to see it, but what we want to see is we don't want to see people killed, and we want to see a little bit of freedom for these people.
Iran says that it will retaliate in the instance of U.S. strikes against U.S. assets in the Middle East. What do you say to U.S. service members about why it is worth the risk to intervene in Iran?
Yeah, Iran said that the last time I blew them up with the nuclear capability, which they don't have any longer. So Iran said that the last time. They better behave.
President Trump there ramping up his rhetoric against Iran. Now let's take a look at how oil prices are faring, because we have been seeing them rallying pretty hard the past 4 sessions against the backdrop of the concerns that maybe supply disruptions from one of OPEC Plus's largest producers could affect the market. And of course, in terms of the commentary from the U.S. president, the extent in which military action or intervention from the U.S. is a possibility. Trump has also been talking about it being a good idea if U.S. citizens evacuate from Iran, reiterating as well an earlier pledge that help is on its way to Iranian protesters. So seeing that upward climb in U.S. crude futures, steadying for the moment, also keeping tabs on some of the Asia energy stocks. Today also seeing some upside there.
The top global headlines that we're following. South Korean prosecutors are seeking the death penalty for former President Yoon Suk-yeol over his botched 2024 declaration of martial law. A verdict is expected next month, with Yoon facing the prospect of either a death sentence or life in prison. Yoon was indicted last year on charges of insurrection after he shocked the nation and the world by briefly suspending civilian rule. Prosecutors in Taiwan are stepping up efforts to block China's tech players from recruiting the island's talent. They've issued an arrest warrant for Peter Lau, the CEO of Chinese smartphone company OnePlus, and indicted 2 Taiwanese citizens who work for him. OnePlus is suspected of illegally recruiting more than 70 engineers in Taiwan. Avril.
Yeah, let's take a look at Japan and the JGB markets, because we have been seeing the Takaichi trade really putting pressure on the long end of things, but looks like on the shorter end, it's not immune. And we're seeing how the 5-year yield has risen to the highest since its 2000 debut. So 1.61% is where we are seeing actually 6.2% on the 5-year yield. We'll continue tracking that. More ahead on the Asia trade. This is Bloomberg. Let's take a look at how Asia markets are faring a day after reaching record highs and climbing by the most in about the week. We are seeing Japanese stocks managing to extend those gains. So too in South Korea, a bit of a turnaround, though not by much, from the losses in the early parts of the session. Now, Paul, we are also watching China trade data for the month of December, and the expectation is that maybe we see a bit of a slowing in exports growth. The on-year figure consensus is for it to come in at 3.1%. Bloomberg Economics maybe a bit more optimistic, expecting at 3.5%. The extent in which the shipments to non-U.S. destinations help to offset a bit lower trade to the U.S. that I think is supposed to figure into the equation when we look at these trade numbers, Paul.
Yeah, that's right. The port data does give a few clues. The container data shows shipments from China to the US tracking well below the year levels through to December. But weekly port data shows things tracking above December 2024, but we don't have export destinations, so it's difficult to know precisely what's happening. But one other encouraging factor that we saw was the most recent set of official PMIs showing manufacturing back above 50, so in expansionary territory there as well. So we'll bring you that trade data a little bit later on when we get it. For now, though, let's head to the UBS Greater China Conference in Shanghai, where our Chief North Asia correspondent Stephen Engels standing by with our next guest. Steve.
Thanks a lot, Paul. Yes, it is day 2 for our coverage here, exclusive coverage of the UBS Greater China Conference here on the banks of the Huangpu River in Shanghai. And our first guest this morning is Christine Peng, head of Greater China Consumer Research at UBS. Thanks so much for joining us this morning. So obviously, domestic demand and consumption is a big priority going forward into the National People's Congress in March. We've seen the various government confabs in Beijing talk about the 15th five-year plan. It's about consumption, domestic demand. How are they going to boost that when inflation right now is pretty much flatlined for the full year?
So I think there have quite a few measures that started since last year. Obviously, it started with the subsidy towards the home appliances, consumer electronics.
So trade-in as well, trade-in program and subsidies.
Exactly.
Yes. Is that going to solve the structural problems, though? Probably not.
I don't think so. Yeah, but in addition to that, I think there are also some targeted measures. For example, the Chinese government announced subsidies towards families with newborn babies.
Yep.
The government is also providing better, support for people who don't really have the jobs, for college graduate students, for also like people who just retired and rely on pensions. So I think there are quite a few measures that have already been announced, but as you said, I don't think that's enough.
So what is going to be needed? And then we'll get into how the investors are reading these various developments and what they're looking at and finding pockets of strength. But what would you, from the head of research and consumer side, want to see from authorities? Or is this the year that we're not necessarily going to see a lot of stimulus on that front?
I think at this point, as a house view, UBS is not really expecting a big incentive to be announced by the Chinese government towards the consumption. But from my point of view, I think what is needed is that the government needs to be more proactive to support the middle class or even low-end, consumers, right, because these people actually have suffered from the COVID and also the downturn in the property market. Right. So I do think there should be more measures to be implemented to support the income growth outlook and also to boost their securities in terms of healthcare, education, etc.
Well, then is it a chicken and egg thing, or which comes first, the cart or the horse? Because do they need to solve the property issues before they can get confidence in the household to end up spending?
Yes. I think property is still by far the biggest concern in terms of consumer confidence, especially for the middle class.
So how are investors, what are they looking for necessarily in this space? Because there's been renewed interest in particular certain areas. What sectors would you say are the most attractive and which would you stay away from?
I think at this stage, obviously, consumer is not really the most popular, sector for the Chinese investors, right? And I think that's not really the only situation for China. If you look at globally, consumer is not really a popular sector for global investors either. Specifically for China, we have started to see signs of recovery for the high-end segment ever since Q3 of last year. Actually, today we are hosting a panel to discuss the high-end shopping malls recovery. I think that's obviously the bright spot for the Chinese consumers.
Are the shopping malls actually seeing recovery? Because a lot of the malls I've been to are empty, right? A lot of people are still shopping, moved online, where a much bigger percentage of purchases is online. So is that going to have to go through a rationalization, the whole shopping mall concept in China?
The overall shopping mall segment is not really doing very well, as you described, right? But having said that, the high-end shopping mall is actually doing pretty good. For example, one of the most popular shopping mall in the high-end segment, last year the same-store sales growth was high single-digit or even double-digit. Most of the growth was actually starting to happen in the second half of last year, primarily because of lower base, but also there are some new brands that have been boosting the shopping mall same-store sales growth.
So what's behind the pickup in the luxury side? I mean, there was a lot of caution on big-ticket items when there was, I guess, less confidence. But has there been signs that this is an improving economy? What's given the shoppers in the high-end, big-ticket items the confidence to spend?
obviously the stock market has been in good rally,
up
right?
17% this year, or last year, 2025, for the CSI 300.
Exactly. The year before actually is also a pretty good performance, right? And also, if you look at the global commodity market, all the commodity prices have been going up, like gold, silver, etc. So there are wealth effects to support the income growth outlook of the wealthy population. But having said that, that's a very small part of the overall population for China.
So what's going to be the net impact if there is success in the anti-involution campaign in EVs? I mean, there's been a price war in cars, price war in batteries, solar, also food delivery, AI companies. There's been sort of a price war, so that indirectly affects the consumer. But what's going to be the net impact of that? Is it going to work to stop the prices, and is it going to stop people from buying if the prices stop falling?
It's hard to say, right? I think from the consumer point of view, I think what is really important is the income outlook.
Yes.
Right. So if without that being improving, I don't really think the CPI, the inflation, is going to happen. I think the most important thing is still the demand, which ultimately is driven by the wealth effect and income growth outlook.
So, I mean, there hasn't been a lot of progress, maybe because the government is also worried about employment and potential job losses. I think the people that I talk to on the street, their number one concern, including newlyweds who are getting married, they're not having a big banquet, they're not doing a lot of extravagant spending because they're worried about their job prospects.
Yeah, I mean, that's been the key issue, right? Especially for the young people. But I guess over the last 4 to 5 years, there have been a big change in terms of mindset, right? You know, in the past, I think for the new graduates, they want to work in the banking industry. They want to work in the very high-paid, jobs. But nowadays, with those high-paid jobs not really being booming, the young people started to become more realistic, pragmatic, right? You can see that nowadays, the auto company seems to be the top choice of the new graduate students. More AI type of jobs have been generated. Right. So I think it's obviously is a mindset change, and also there are some job opportunities in the so-called new economies. Right. I just said the new energy, the auto companies, the AI company, even in consumer companies, we see some opportunities as well.
So in the consumer space, if the investor who's watching this wants to get into this area while it is a bit depressed, what are the 3 areas that you should and 3 areas you should avoid?
I think the 3 areas we have been recommending to investors, obviously gold jewelry is a very good segment. IP retail, we are still pretty bullish, although there are some bumping share price performances, but we continue to like the sector. We also like the fresh-made beverages. We see pretty significant consolidation opportunities for the big performers. So that's the 3 areas we have been recommending to investors. On the negative side, we are still worried about the Baijiu segment. Yep. We are getting less bearish than before because share price has fallen
and then there's also a story with Diageo wanting to essentially sell their swell fund stake. So there's some rationalization going on there. But
valuation has become more attractive. But fundamentally, we are not really recommending investors to buy it. We are also concerned with some of the so-called new economy stocks, but fundamental is not really supporting very high valuation. And we are also still a bit worried about the offline, for example, like the supermarket transformations. But we are trying to be more, selective when it comes to stock picking. Even in a troubled industry, there are good performers and bad performers.
So the Baijiu sector also hurt continually by the anti-corruption campaign as well, right?
It's becoming less.
Okay. You mean
2026.
The crackdown is less?
Yeah.
Okay. All right. Christine, thanks so much for your time.
Thank you.
At your GCC, Greater China Conference here in Shanghai. Okay, guys, going to send it back to you as we've kicked off day 2 coverage exclusively from the GCC here of UBS.
Thanks so much, Steve. Speaking there to Christine Peng of UBS. Now, subscribers can also watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions we talk about and become part of the conversation by sending us instant messages. Check it out at TV Go. This is Bloomberg. Okay, let's take a look at how Asia currencies are faring. We have, of course, been seeing the Korean won on this longest losing streak since the year 2008. That seems to be taking a breather for the moment. We, of course, did get jobs numbers. Bloomberg Economics has been giving us the quick take. Don't panic. They say this is due to technical factors, this unexpectedly high jobless rate. Now, tracking the moves in the yuan and the yen. Of course, the yen has been in focus after hitting its weakest level against the greenback since July. It's been underperforming the G10s. Let's get the outlook with our FX and rate strategist, David Finnerty. So, David, anything to stem the fall in the Japanese yen?
Well, obviously, fears of intervention are definitely looming, particularly when you're approaching that 160 side. I think the other thing, actually, as you approach 160, there's a lot of option barriers around that sort of level. So option traders will try and defend those barriers, depending on which side you are. So that may slow its progress. But certainly, if you look at yesterday's entry, most of the trades on options were more bullish trades for dollar yen to move higher. So you're still seeing some sentiment that, hey, we think there's still more upside to it. I think the market's looking for more of a grind than a certain knee-jerk move. But the market also at the same time is very wary of intervention risks. And you are certainly seeing some players in the market buy downside options to hedge basically or speculate on a downside move should there be intervention anytime soon.
David, it's not just the yen that's feeling the pressure. The Korean won, I think it's on its longest losing streak now since 2008. Can you talk to us about what's driving this? Where's the floor? And could we see some intervention?
Well, we're certainly, in terms of intervention, we're approaching levels where verbally there was intervention back around Christmas time, just before Christmas. Authorities warned about its excessive weak level and said they were willing to show a strong determination if needed, so basically implying that they may intervene. So we're approaching those levels again at the moment. What's happening is retail investors in Korea, they continue to buy foreign assets, foreign equities. So through Monday, you saw about 2.4 billion of outflows from retail investors. If you combine that with this week alone, you've seen about 500 million of outflows from global funds. So you're seeing these outflows into other equities. Combine that with imported demand for the dollar at the moment. All those factors combined are adding to this one weakness. The markets will certainly be looking for, if dollar won approaches 14.87, which was last year's low, given that it was around that level back in December that said the authorities did come out and basically give a shot across the bow, shall we say, that there may potentially be some intervention.
Just picking up your point earlier about what can help stem the yen weakness, we're hearing this chatter about potential for an early election in Japan. Does that in any way bring forward the odds of a BOJ rate hike? And in terms of messaging from Ueda-san next week, how hard a job does he have?
Yeah, I think it's difficult because the market is pricing in 1 to 2 rate hikes this year already. So you're going to have to be more aggressive than that. And BOJ historically doesn't move at that sort of pace. You know, about once every 6 months it goes through. And also the other thing, the problem is for Ueda, he's got to act in line sort of with the government. Yes, he doesn't want the government to say, look, here is your policy, but they want to be seen on the same page. And obviously with Takaichi's stimulatory policies, the idea of a rate hike doesn't always tie in very quickly. So the idea of gradual rate hikes sort of ties in better. So for Ueda to come out and signal, look, we're going to be a lot more hawkish than I expect, is very unlikely. So therefore, yen weakness seems to be the bias.
Which are the other currencies that you think this yen weakness most vulnerable on?
On the yen, well, where the yen goes, other countries follow. I think at the end of the day, the won will tend to go because of the nature of the exports, similar exports. The won certainly will add, yen weakness will add pressure on the won. But again, at the end of the day, I think the dollar side of the equation will dominate at the moment. And that's what I think the key thing for that is what's the Supreme Court ruling on Trump's tariffs, which may come out later today.
All right, Bloomberg's David Finity there. Let's take a look at how we're shaping up in terms of futures ahead of the China and Hong Kong sessions. Those markets opening in about 40 minutes' time. We're seeing a little bit of optimism around Hang Seng futures. Of course, yesterday was a pretty good day for the Hang Seng. It's a bit weird. We've got a day without an IPO or a stock debut in Hong Kong today. Taiwan futures also looking positive. FTSE China futures, though, kind of flat at the moment. We are awaiting trade numbers, of course. December exports expected to come at 3.1%. That's a bit slower from November. Similar story for imports, accelerating at just 0.9%. And we heard Steve mentioning a little bit earlier that Diageo considering a sale of its assets in China. This is according to people familiar with the matter. That would mean the 63% stake in Sichuan Swell Fund, which Diageo holds, could be up for grabs. That stock down 14% over the past year. Still a bit of relative strength there for the yuan as well, 697.41. Avril.
Paul, here are some other corporate stories we're tracking. Morgan Stanley has increased bonuses for its bankers in Asia and Europe after a bumper year driven by trading and deal making. Bloomberg sources say payouts in Asia rose by about 20% after the firm closed in on a record $10 billion in revenue from the region last year. Meanwhile, investment bankers in London reportedly received a 10 to 15% bonus hike, while deal makers in Europe got as much as 15% more. Bloomberg has learned that Rio Tinto is bringing in a slate of bankers as it pursues a deal for Glencore. Sources say they include top UK rainmaker Simon Roby of Evercore as well as JPMorgan and Macquarie. Citigroup also said to be in talks for a role after its involvement in many of Glencore's recent transactions. Boeing sold more jets than Airbus last year, snapping a 7-year losing streak as it recovers from a difficult period of corporate crises. The U.S. firm booked about 1,175 orders for the year, including a Qatar Airways deal that's the biggest in the company's history. Boeing also delivered 600 planes last year, capped off in December with its best monthly showing of the year. We have more ahead on the Asia trade. This is Bloomberg.
Tributes are being paid to one of Hong Kong's most vocal activist investors, David Webb, who has died from cancer at the age of 60. Webb's investigations into corporate misconduct triggered regulatory action and made him a prominent figure in the city's financial industry. Bloomberg senior editor Richard Frost is with us now from Hong Kong. So, Richard, tell us what lasting impact did Webb's investigations have on Hong Kong's corporate governance and regulatory landscape?
Yeah, I think what he really achieved was, particularly within the kind of smaller and mid-cap companies, when it came to the stock market, was improving regulation in terms of oversight. He was very sharp on examining the different sort of invisible relationships between companies. Most famously, some years ago, he uncovered this network of 50 companies, which he said were sort of connected in a way that they shouldn't be. That prompted the securities regulator to launch the biggest investigation at the time into the companies. A lot of them sort of their shares collapsed as a result. So really, his focus was shining a light on some of the darker corners of the corporate landscape of Hong Kong.
Richard, I imagine, given how vocal he was, there might have been some detractors to his approach. Talk to us about how his activism shaped relationships with financial institutions, business elites in the city.
I think, everyone sort of recognized that David Webb was this ferociously intelligent maverick who was very enthusiastic about creating a more level playing field across Hong Kong. And obviously, people and companies who benefited from a less fair playing field, maybe they won't be as sad to see him pass. He even made that point when he gave his final fireside chat sometime last year. But I think overall he really won the respect of whether it was foreign investors in Hong Kong, whether it was locals, by fighting for different parts of what he thought Hong Kong should be. It might be sort of dismantling taxi monopolies. It might be looking at how companies were engaging in a way that they shouldn't be.
Richard, thank you very much. Bloomberg's Richard Frost for us on the passing of David Webb. Now that's it from the Asia trade. Our coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. The China show is next. This is Bloomberg.